All right. So I made a couple videos on liquidity, and I know they helped quite a few people, but I also realized that in these videos, I assumed that you understood certain things that you maybe don't understand. And so what I'm going to do is I'm going to go kind of to ground zero and build from there, so that to make sure that you understand kind of these concepts when it comes to markets, okay? And so in markets, they're driven by auction theory, okay? And it does not matter what the market is. The market could be houses, the market could be futures, options, crypto, stocks. It doesn't matter. It's all exactly the same. For every seller, there has to be a buyer, because that's an auction, right? You can't buy anything from no one. You have to buy it from a seller, right? You can't sell anything to no one. You sell it to a buyer, right? So when people say, "Oh, this is all sellers," I mean, it's not. There's buyers in here too, because people are buying from the sellers. It's just that these sellers are more aggressive than the buyers are, right? So let's kind of talk about that. So you have this house. It's for sale. It's $500,000, okay? And so that's what the asking price is for this house. And then you have buyers, and they're only willing to pay $490. They're only willing to bid $490. I hope you love these crude drawings, because they are a blast, I tell you what. So what's the only way that a transaction happens between this seller and this buyer? Well, the only way is if the seller gets aggressive, crosses the aisle to meet the buyer at their bid for $490. So basically the seller's saying, I wanted $500K, but the house is not selling as fast as I want, so fine, I'll take $490. You got it, Mr. Buyer. Buyer's happy. Great. Or maybe you have a scenario where the seller doesn't care if they sell this house or not. They're chilling, dude. And so the buyer's like, I really wanted to pay $490, but fine. You drive a hard bargain. I'll give you your $500K. Great. Transaction happens. Everyone's happy. So this kind of further brings us, and I'll talk about this too. This is the spread. The difference between these two things is the spread. The difference between what people are bidding and asking in the price is the spread. Okay. So in this instance, it's a $10,000 spread. In stocks, it's usually a couple cents, or in futures, it's a tick or two. But anyways, so now let's get into this other concept, which fits right in here, which is supply and demand. So crude. I love it. Okay. So if supply increases, suddenly there's 100 houses for sale, but there's only one buyer. Supply just increased. What's going to happen? Well, now the buyer can go to 100 different people to get his house. So now there's a bit of competition between those sellers, isn't there? So what are they going to do? They're going to start lowering prices to compete with each other, right? No, buy my house. I'll sell it to you for 400. Buy my house. You know what I mean? And what happens when there's an increase in demand? If there was 100 buyers, but only one seller, only one house and 100 buyers, well, what's going to happen? It's going to increase prices. Why? Well, all these buyers are going to be elbowing each other, going, no, sell your house to me, sell your house to me. You want $500K? I'll give you $700K. And so I was like, okay, yeah, dude, I'll sell your house for $700K happily, because there's an increase in demand. Therefore, there's an increase in price, right? So this is auction theory. So understand this. This is what all markets are built on. Okay. So now I'll put that over here, just so you kind of have it in the corner of your eye sockets. Here, let me do this now too. Oh, I love just how crude my teaching method is, isn't it? Just the best thing. All right. So keep that here. So now we're talking about markets, aren't we? We are. That's a little better. Still a little horrible, but all right. Okay, dude. Fine. So let's say we're just in some kind of bullish market. Price is just kind of grinding up. And then price kind of hits some consolidation area where things get a little stale. right? I'm exaggerating here, but price is getting a little stale. And let's kind of go through the mentality here. We had buyers that bought here. They bought anywhere, all in any of these spots. There were aggressive buyers that stepped in because it's a bull market, right? And so what do people do? Well, people put their stop losses below lows typically. I do it. You probably do it. Everyone does it, right? And then you get to a point where there's a battle. There's a battle here in this consolidation area between sellers and buyers, right? You have people that think that price is about to reverse and start going down. And you have people that think price is going to now start continuing up, right? There's a battle. And what's happening between those two? Well, if you're a buyer, right, you're putting your stop loss under this low. And if you're shorting, you're often putting your stop loss above this high. So now just conceptually, what happens if these sellers, these short sellers, get rinsed out of their positions? Well, there's a mad dash for these short sellers to cover their positions. Which, how do you cover a short? Well, you cover a short by buying, right? And if you're panic buying, remember this example now, there's a huge increase in demand for these short sellers to get out of their short positions. There's a panic increase in demand. So what are they going to do? Well, they're going to pay the ask, right? Remember, increase in demand, 100 buyers, one seller. The seller gets $700K for his house instead of 500, right? That's what happens here. That's what drives price up. Now, flip that on its head. If price was to come down, and we're rinsing out these buyers, what's happening here? If there's a panic for them to sell their positions, right? Panic selling. There's an increase in supply, which is going to drive the price down, right? There's an increase in the number of houses. So now these buyers can go wherever they want to get houses, right? And so the sellers start dropping their price. Please, just take my house. Just take my house. No, take my house. Price goes down. Okay. So now on top of that, let's pretend JP Morgan, I love to use JP Morgan because everyone knows who they are, wants to get involved in this. They think that the price is going to continue up. But if JP Morgan just market orders into this, price is going to rip so hard. And why would JP Morgan not want that? Well, now instead of buying their 1 million shares at whatever this price is, $50, they're going to get some of their 1 million shares at 50, some at 55, some at 60, some at 70, which is going to what? Cost JP Morgan way more money. They'd much rather buy it down here, right? So what do they have to do? Well, they have to trick people into fire selling their long positions, and they have to trick people into piling into shorts. They have to do both of those things, right? Because that's what will drive price down. So if JP Morgan convinces all these people that were long through all these places and all in here during the battle to panic out of their positions, right? What are those people doing? Well, they're slapping the bid, okay? And then JP Morgan's going to step in, buy whatever this is for $45. And because there's so many participants that had their stops here, it's easy peasy for JP Morgan to fill their full however many millions of shares right here and kind of in this area instead of way up here, right? And so what might you also see here? Well, you might see, if you're watching volume, you might see a spike in volume in this area, right? You might have low volume all through here, but when this low gets taken out, you see a spike in volume. That's JP Morgan taking all these suckers' positions from them, right? Trying to build this foundationally, right? So now, if you understand that, right, what's kind of happening in the scenario here? Stop losses below lows, a battle. Everyone's stop is here. JP Morgan rinses these people out, takes their shares from them, right? Then you also have the people that were short that got real excited, maybe added to their shorts somewhere around here. They stop out of their shorts up here. So what you're ending up with is a whole bunch of people on the way up that are now slapping the ask because there's a raise in demand to get into this. You know, people were rinsed out that were long. They're like, darn it, I'm a sucker. It's starting to move up again. I'll slap the ask to get back in, right? Then you have your shorts. Oh man, I need to cover this. I'll pay any price to cover these shorts. Slapping the ask, driving price higher. So that's why you'll see, in markets, price will just do some whatevers, come down to some low, and then rip. And you'll be like, what the fuck, dude? I just got stopped out. And then it ripped price. Of course it did, because you put your stop where everyone else puts their stop, right? Because we're just humans. We're all humans. And so now flip this on its head. Let's say we're in a bear market. Skiddly doo, scram gadoosh, right? You have, I know it's ugly, but you have the battle of people that think it's going to go up, people that are shorting, thinking it's going to go down. The people that were shorting got tricked because price went above this area where they had all their shorts, or where all their stop losses, I mean. They got out of their positions. JP Morgan starts shorting, pushing price down. These people that got stopped out of their short go, oh, darn it, I was tricked. They start piling back in, slapping the bid, right? And then you have the people that figured this was going to be the reversal point, that have their long stop losses just under here. They get rinsed out. Again, they have to slap the bid to get out of their long positions, which drives the price down, right? So now let's get rid of all the, fancy talk. If you see consolidation, a rinse and a go, that's what's happening, right? And it can look like many things. It can look like this because stop losses are here, right? It can look like this because maybe stop losses were in all these spots, right? They took all those people's stop losses and then went. And you can flip these all on their head. You can skadoosh, right? Long stop losses. You can scrididdly donk, right? Stop losses. Maybe some of this, stop losses. And this is all liquidity. JP Morgan needed liquidity to fill their 1 million share order, right? So I hope that makes sense. Oh, I really hope it makes sense. And that's like what happens. That's what happens in these locations. JP Morgan is trying to get in. So what do they have to do? They have to keep tricking people into going short, tricking them to put their stop losses in these areas. And then they just finally pile in and let it rip, right? If that doesn't make sense, let me know. And let me know why it doesn't make sense. And I will try to remedy that. All right. Thanks for watching. I appreciate it. You guys have been so nice to me. Appreciate it. Have a great day.